Hello, everybody. Welcome back to another 21st Century Renaissance and another open interest newsletter breakdown on GameStop. I'm your host, Dr. Michael LoPiano. It's wonderful to see you all once again. A tough day yesterday, a little bit scary, a little bit of uncertainty there, right? Sometimes we get those days where things don't quite fit our paradigms, right? The stuff we see 95, 98% of the time on some of these smaller time scales, right? Something pops up that reminds us that we live in a not perfectly predictable environment. But that's not to say that what we saw take place yesterday was something completely unprecedented. And in fact, it's something that I started talking about early this week. I'd say personally, as far as I was thinking, this was something that we would potentially see coming out of Opex rather than in the middle of Opex week. But let's break this down and take a look at what I'm talking about here as I go over how I describe this in today's newsletter. So for those of you who are joining us for the first time, every day I post analytics, technical, and options analysis on GameStop on my X page. You can find it if you're watching this on YouTube, linked in the description below. If you're watching this on Twitter, you can find it pinned to the top of the page. So let's hop into this today. I have titled today's article, Shorts Enter New Volatility Cycle. So what am I talking about here? So it has been a number of different YouTubers, analysts, and people on Superstonk over the past few years have put a lot of work into discovering and describing variations on a pattern of cycles. Now, in order to understand these cycles and what they have to do with GameStop, it's necessary to approach the full picture from the perspective of the options market as well. One thing I talked about in my video on Monday, sort of a video that incorporated a lot of the broader context that GameStop has been in over the past, not only just few months, but year and 4 to 5 years, is understanding, right, that market makers, GameStop, right? The options market has incredibly expanded over the past several years. And or it's certainly there's more access to it than ever before. Options volume and options trades are at heretofore unprecedented levels. You've got, this is even very recent with respect to, say, stock market indices like the S&P 500, like exchange traded funds like SPY that have to do with the S&P, that track the S&P. We've only had daily zero DTE options on SPY going back to 2021. So in order to understand, right, how these cycles work, it's necessary to think in terms not only of price, but also of volatility. And a lot of what I've been writing over the past 8 or so months now has also been part of this exploratory endeavor to see and track how not only price movements, I would say how price movements correlate with the structure of the options market. So in particular, we talked on Monday and we talked on Friday's live stream about how this volatility cycle, so a cycle wherein much of GameStop's price action is moved around in order to generate or to depreciate volatility so that options market makers can maximally profit off of those fluctuations in volatility, which in many cases is not only more profitable in terms of the margins of profit with respect to who is engaging in those trades, right? Even sometimes if these short trades, these short share trades occur or are closed out at a loss, something like that, or aren't terribly profitable, the probability of the success in the options market of selling volatility and then being able to go long volatility back when liquidity is restored is incredibly profitable. And we've seen some of these cycles pop up very recently. Certainly, with the return of Keith Gill to our current context on GameStop is one that has made these volatility cycles a little bit less predictable, say, than they were between 2021 and early 2024. So, right, the first step in this volatility cycle is, right, you have the price, GameStop's price goes up, volatility goes up, right? So with GameStop, volatility and price are directly correlated. Not perfectly correlated, but directly correlated to a reasonable extent. So when you see GameStop's price go up, the implied volatility of GameStop goes up with it. And it's at this point that market makers, major players, major institutional players with access both to borrowing large volumes of shares with, say, creation and redemption orders, the ability to strategically fail to deliver shares that are borrowed from ETFs containing GameStop and other basket stocks, and with broad market-making strategies, dealer strategies with advanced hedging techniques, are able to both short the stock and sell the volatility that is inflated, elevated, let's say, at any given point in time. So what we saw take place yesterday was at least one institution. It may have only been one institution, wouldn't necessarily have to be multiple, but certainly at least one major institutional player pulling the trigger on starting one of these large short and volatility cycles, right? These short volatility cycles. That might be a little bit concerning, right? Especially when we see things like technical support levels fail, when we see things like major resistance and support points in the options market basically get blown out. It can be scary. Certainly, that causes me to really say, okay, what's going on here? Let me get my attention on here. What's really moving around? When we see these events that seem to be low probability events take place, it can be a bit concerning, but it's under these circumstances that certainly when I'm trying to understand what's going on, I sort of bump out to different levels of analysis to try to make sense of what I'm seeing. So I'll walk you through my thought process here and why I think that what we just saw yesterday was an attempt to jumpstart this cycle before we get into Opex. So if we head down here, right, I do have this linked. I've got the particular video where I go into this broader context, and the article from Monday is linked here on the article. So do go ahead and take a look at that. I'll also put the video link in the description of this video. So, right, obviously, when we see something like this and we get ejected from our technical structure, right, that may be the sort of thing that causes hairs to stand up on the back of your neck, something like that. Right, we had been trading in these regression channels, these particularly bullish regression channels, throughout really the past 2 months, about 10 weeks of trading. And early in the day, right, we had no reason to suspect that we would get ejected from these channels. We certainly, within our sort of bullish regression sub-channel, the smaller of these channels, which had formed from Thanksgiving to the present, we showed respect of our technical levels here. So we traded up, we got this. It looked like inflation data from yesterday, like the broader market was responding very positively to inflation data yesterday. We were on the track for a major recovery. Certainly futures went from about, let's see, SPX level like 5790, 5800 up to 58750. So big move there, pre-market, right before market open. We got some of that action early, and then it dumped off. Right, it looked like GameStop traded a bit in sympathy. Like I said yesterday, I thought was a possibility we could get this down move out of the open, but we had so many of these technical levels beneath us that we would find support here, and we did early in the day. As we fell off here, we found support atop the support line of this more slightly less bullish, but still bullish, this post-Thanksgiving regression channel, which lined up also with what was this support point? It's not quite at 30, but 30, 50 here. This may have not had an overlapping technical level here. Let me just check our 4-hour chart so I can take a look. Yeah, it was just below. It had sort of dipped below our 100 4-hour moving average that we had traded at. So we started off the day right on top of that, and then we fell down to to this the supported regression channel spot here. And then we dip down again. But this happened, right? This happened only on the tail of some huge volume here. And I have reason to suspect that this looks like very direct targeted short volume. And the question that I raised in yesterday's video was, hey, okay, you're going to need to borrow a lot of shares to move this through what was yesterday and what is now our call wall, our call gamma exposure wall at $30. It's very strongly supportive, meaning that it requires, if you're approaching it from above, it requires a very high amount of supply in order to overcome that level, in order to push the price through that particular hedging level, as market makers are going to hedge in the opposite direction, or they're not going to hedge as strongly once you get there, right? So market maker call gamma hedging is going to resist the price's movement through that level and provide a lot of resistant demand to supply as it comes in to move the price down. So it required here in about 6 minutes, right? We got 700,000, right? Over 700,000 shares of short volume. Okay, right? We had SPX was trending down, so our market context was bearish. That certainly didn't help things. But right, we found support early, and at 11 a.m. we got this massive concentration of short shares. It does look like they were borrowed directly. So this was direct short volume, and as I took a look at the international brokers' shares available to borrow, we did have settlement activity that accounted for 700 to 800,000 shares overnight, which were short. So in pre-market, we had about 1.1 million, 1 million to 1.1 million shares available to borrow. Didn't see those numbers move very much during the day, right? So that I suspect that this is tactically done so you don't know when an institution is about to drop this volume, right? So they go ahead and borrow the shares, but then the numbers don't actually update until the settlement happens. So they have a way to disguise this so you can't have a tell in the data. But right, we dipped down overnight in the middle of the night to only 300,000 shares available to borrow. And as of pre-market today, they ticked back up to about 1 million. So that is what I believe. I believe in a single institution borrowed those 700,000 shares and then dumped them all at once, knowingly, right on top of the call wall to push us through that call wall. The only thing about that, right, is even that was not enough shares to really definitively push us down. As you can see here, we found support, again, as I talked about yesterday, at the next technical level down, which was the 200 4-hour moving average at about 29.75. And you can see this, right? We bounced right off that level and then kind of had this pin between 29.75 and 30. So we just traded in this very tight channel while nothing really happened, right? There wasn't then an additional amount of organic desire to move the price off of this point. So we had this, right? We had a number of buys come in basically when the price would dip down to that 400 moving average. Traders, the broader market was basically saying, or GameStop's market was basically saying, I'll take shares here. I'll take shares here. I'll take shares here. Nope, I'm not gonna, I'll take shares here. And so this technical support, offered this navigational point for traders to say, I like this, right? Here's demand. Here's demand to keep the price from moving down. But of course, then now $30 was overhead. And so this then served as a very strong resistance level on account of market maker hedging, sort of counteracting that price action. So providing supply rather than providing demand as the price moved up. So accordingly, right, we got stuck in this area, but stayed supported. Somebody would have had to essentially cover this position to then move us, all the way back through and sort of back into this territory. But this meant that we only had a few 100,000 shares likely of direct shortable volume available to kind of dump on the stock. However, it looks like, and I have to thank Eric over in Outlier Trading for pointing this out over on AMC. The continued downside was a combination of two factors. Number one, we moved into an area where there was very little net call gamma exposure to offer resistance to the downside. Not right. GameStop doesn't have a lot of put gamma exposure on it. Doesn't have a lot of negative gamma exposure on it. So it's not like we slipped very quickly, right? So for example, on SPX, right, we see how dealers, I suppose, have a lot of they have a lot of short put gex, or they have a lot of long put gex in these lower strikes. So it's causing these big swings when you're in a negative gamma environment, increases volatility to the downside or to the upside, right? If you're in this negative gamma regime, that you're going to have those properties. We moved into a more neutral territory, so not necessarily super volatile, but nothing really happening in terms of market maker hedging to keep the price buoyant. And so in order to keep the price moving down, once it seemed likely that we weren't going to get any more retracement out of SPY as well, out of the S&P 500, the broader market, it looks like exactly at this point that market makers, institutions, whoever wanted GameStop to continue moving down, market makers are certainly incentivized to do this if they have this huge short call position at $30. Then it looks like they put their fingers on the scale here through ETFs to short ETFs. So rather than short GameStop directly at this point, they then kept their short position open and then started shorting ETFs. And the evidence we have for this is you can look and see how price action on GameStop and AMC, right? So AMC and GameStop, not super highly correlated most of the time, but there are still some ETFs that hold both of these. Whatever ETF was shorted yesterday to get GameStop's price to go down, that ETF also contained AMC. Maybe it's worth it to go out there and do some research to see if anything else had this exact price pattern. But you can see, right, even these little twists and turns. Now, what we don't see is that huge volume of direct shorting in AMC. We only saw that huge candle earlier, right? This 6 minute, right? This 700,000, this huge steep candle. We did see AMC track down, and it's been tracking down with GameStop over the past few days. Again, thanks to Eric for pointing that out. But we didn't see this move. We did see, however, after that move take place, that the charts then lined up pretty much exactly. Right? So we get this move down here, this dip with the retrace. Then we have this kind of V-shaped movement here, kind of a peak and a V-shaped movement. Then we kind of crest up a bit, not quite as high. The moving averages, look at the position, the relationships of the moving averages between AMC and GameStop. They're very similar in very similar positions. We have the 200-minute moving average crossing over the volume-weighted average price at exactly the same time. Not exactly. Okay, that's hyperbole on my part. Very close to the same time. But we do have similar patterns here. We also have this kind of spike, right? Just before 2 p.m. We have this spike here. I suppose it's just before 2 p.m. on AMC, but it's slightly after 2 p.m. on GameStop. So not exactly, but we can see the similarities in pattern here. And then we get this larger move down, and then at the end we also get this this sort of buyback. So look, I mean, that's probably not definitive proof at this point that this was ETF shorting through a common ETF that holds these, but I think it's a pretty strong case seeing the similarity of the price action on these stocks, given the time that they move and sort of the overall pattern here after a certain point. So I suspect that occurs. So really what this looked like to me is something like a 1-2 punch early in the day, direct heavy shorting on GameStop, drive the price down, drove volatility down too, right? So volatility moved down from around 120% to a low of something like 98%, 30-day implied volatility on the day. The price continued to trade down until what looked to me, right, it hit 28, a very deep, there's a very deep technical support around 28, slightly below 28. I think the 200-week average is what I'm talking about here. And we had support yesterday. There's a navigable spot. Where is it now? It's, gotta zoom in here. It's it was at 27 slightly above 27.90. So we closed to within a couple cents of this level yesterday. Our close was 27.88, and this moving average was at like 27.90 or 27.91. We also at 28 had what looked to be, because even though it's a neutral gamma exposure level at 28, right? We have basically an equal amount of call gamma and put gamma kind of canceling each other out, as long as they're short calls, I guess. And in any case, the gamma exposure levels cancel out, so we have something of a neutral position there. But because of the accumulation of points, there's puts, I should say. This can sometimes have this put wall effect, as I understand it from the way Spot Gamma talks about this, due to a sort of like kind of Vanna bump. So a change in delta based on the IV relationship. So this may have caused, right, just for a little bit, this small bump at this level due to an inversion in the Vanna exposure levels, which caused some hedging. I'm not going to go into this too much because it's a concept that I still need to do some research on in order to fully understand. But there were some sort of aberrant Vanna values at the $28 strike that may have also contributed a little bit of this kind of slightly soft bounce, which may have helped that there was that technical level there at the 200-week average. Like I won't go. We don't have to terribly dissect this in detail right now, but we can talk about this more maybe during the live stream on Friday. But nonetheless, that does look like what happened, and of course this drove tens and tens of thousands of calls that GameStop's market maker, designated market maker, Wolverine Trading, is likely short. Much to their advantage, right? Much to their profitable advantage. So tough, right? Certainly tough, but not unprecedented. In fact, you'll recall on Monday, I talked about how this volatility cycle dynamic is something that Roaring Kitty and Ryan Cohen, I strongly suspect, have detailed knowledge of, that they understand these dynamics at play, and that basically what Roaring Kitty has been, not even necessarily exploiting recently to his own financial gain, but what it seems institutions may be using his tweets to exploit is the knowledge that institutions dig into these short positions, dig into these short volatility positions, and then have to, in order to prevent this from kind of blowing up in their face, in order to make sure they profit maximally, to kind of escape through the back door, right? To go over to their ETFs, to FTD, strategically fail these ETF shares, and then over time be able to acquire these without seriously agitating the price in IV until they're ready to move out of their short volatility positions, and they enter long volatility positions, and then use covering, or if not covering, then some other sort of catalyst, such as earnings, in order to rocket the price back up so that a new volatility cycle can begin. Now, this looked like what they were trying to do. They were trying to take this huge implied volatility move ahead of earnings and enter into it, right? Enter into this, sort of sell the top, short heavily. I wrote about this back between 11.29 and 12.5, right? To short this heavily, eject us from our technical structure, which was, bound here by the 100 4-hour moving average. It was a much narrower channel, or a much steeper channel we were dealing with. Looked like we were headed towards about 40 back at that point. And they attempted to eject us. They successfully ejected us, right? Shorts successfully ejected the price out of this particular channel, and it looked like we were heading down to this deeper support at the 200 4-hour moving average. But on the 5th of December, after basically, moving us deeper and deeper and deeper into this position and piling on more short gamma, more short call gamma, more short call gamma onto their portfolios, that is, we got this Roaring Kitty tweet that rocketed the price, right? I mean, in seconds, millions of shares hit the tape, and then rocketed the price from $26 back all the way up to 31. So this was, of course, the time you cover post on Twitter. And then, okay, right, we sold off back a little bit. And I'm sure that perhaps a number of shorts or volatility sellers did not exit their position because of the precedent that Ryan Cohen had set earlier in the year around earnings times to offer this kind of liquidity valve that would allow volatility sellers and shorts to exit their positions by buying by sort of buying shares off of the lit market through these at-the-market offerings with the company. Of course, Ryan Cohen this time surprised everybody on the 10th of December by choosing not to do an at-the-market offering. So shorts could not escape. They could not close their positions without buying on the lit market. And right around Christmas time, the 23rd, XRT went on reg show. So this suggests that they were starting to have liquidity issues. This is what I was talking about sort of toward the end of last week and early this week, that GME was in a liquidity crunch. Directly available short shares got down to 100,000, I think early last week or in early January in any case. And yeah, it certainly looked like there was a liquidity problem that really perhaps what carried on our bull trend here was the fact that, you know, these shorts and these volatility sellers simply had to juggle their positions in other ways, had to close their positions. They couldn't rely on what they had expected going into earnings, and this carried our price up a bit. Now, right, this pattern is basically the same, right? This is the same type of move. This is an attempt to set up the same type of dynamic. Now, the question then is, what is the liquidity providing event that whoever entered into these positions is looking for? Or are they confident enough, basically at this point, to fail their position, right? To fail to deliver, because we have this huge Opex coming up soon, coming up on Friday. Are they confident enough that Opex is going to protect them, that they're going to have enough liquidity following that Opex in order, right, as these contracts expire, there's going to be a lot of shares that are freed up, that's going to give them the liquidity to be able to exit this position without necessarily rocketing the price back to a place where it's going to threaten their short volatility positions. That I guess is what they're trying to pull here. But then the question is, are they not concerned about someone like Roaring Kitty or Ryan Cohen, or maybe even right? See, this doesn't even have to be Roaring Kitty coming in with a tweet to do this. Like, other institutions, I imagine, would be able to perceive that, hey, this is what Roaring Kitty has done this year. This is what Keith Gill has been able to do this year and pull off. You know, they're not going to come out and say on CNBC that this is what he's doing. But, you know, they could do this themselves, right? They themselves could put the hurt on one of these volatility cycles and possibly squeeze the shorts and these volatility sellers out of these positions they just entered into. One of the things that's helped provide liquidity for shorts in these types of positions has been when GameStop has been in a bear market, right? So the broader market as a whole in 2022 and 2023 was bearish. We had a localized bear market, a pretty steep bear market correction. I mean, it was still a bull market overall, but this bearish correction between March Opex and April Opex of last year, that set up this slam dunk in May and June, right? That kind of localized bear market condition. We're in that type of environment again. So it's different than what we were seeing back here around Thanksgiving. Although maybe we did have a bit of a correction. I'm not exactly sure. Did we have a Thanksgiving correction? We did, actually. We did. That's when we topped, I guess. So the market topped like on the 2nd of December and then started to come. But I guess it was topping, so it's a little different setup. In any case, you know, if we get a very strong response here, if this ends up being just a small period of correction, and we trade back up, say into these support, this more stable territory above 5,900, above 5,950, we get back into the 6,000s on SPX, right? Then what's going to go along with that is there's going to be some pressure maybe on some of these ETF positions, is my guess, and that's going to kind of make the conditions a little bit more risky for a reversal to the upside, where some of these guys might get trapped in their positions. Obviously they can try to wiggle out of them through ETF stuff, but yeah. So I mean, what are we looking at here today? Again, right, we might get the possibility of this type of reversal. Without considering that type of catalyst, if we look at our technicals, we do have our next sort of, we are right on top of this 200-week moving average. It does look, because I'm recording this right about as we're opening today, it does look like we had a favorable response, at least early, to that CPI print, despite the fact that it's up a little bit. Inflation is up a little bit. It looks like a positive response to it, at least initially. And it does look like GameStop is therefore trading, back up above this level. Yeah, so we're back into the upper 28s. Oh wow, yeah, right at the open, we went almost back to 30 there, into this 29 territory, 29.34. So we'll see. It does look for now like we're still kind of in this more risk on territory, but it does look like we use that deeper and that deeper support, that longer term support in order to keep these positions, keep the price more buoyant. So that's good. But if it should be tested again and fail, we do have another deep support on the weekly chart down close to 25. That's at 25.70 right now. That's the 20-week moving support. On the daily chart, we've shot back up over the 54-hour or the 50-day moving average, which is what the 50-day moving average. But then beyond the 50-day, like if these other supports, if the 200-week were to fail, if 28 were to fail, in the options data, we'll see we have a little bit of a speed bump at 27. But basically, technically speaking, from a technical perspective, like the price looks like it's in position to retrace back to 25. That's essentially what that would mean. Since this whole, all of this structure we've been in is basically like, wad up some paper and toss it out until we get enough trading, until we get enough consolidation for a new structure to set in, for our current paradigm to transform into something else. Yeah, if we get sort of rocketed kind of back up in here, like it's still not going to be the same paradigm. Just like we got this paradigm transformation back here, it was a lot narrower and a lot steeper, right? We were looking at something, our bullish regression channel was basically framed at its lower bound by the 54-hour moving average here. So it was, it was something like this and going up. We weren't really trading in this area underneath here. And then it broadened up once we went down to kind of test these lower bounds. We went below the 104-hour. So whatever occurs here, it's going to adjust. We're going to have, a different kind of local sub channel is going to form up. Maybe it transforms. Maybe we move into something that's a little bit more range bound. Hard to say at this point, but there needs to be time in order for this paradigm to transform. And right now, it's because of this action, because we're kind of jutting out of here, it's no longer offering us the same type of discernible navigational advantage that it was prior to yesterday's trading. That's what happens. Just like what happened back in December there, right? December 4th, what was it? December 2nd, we said bye-bye to the 54-hour moving average. And then on December 4th, we shirked, or December 5th, we shirked the 104-hour moving average. And so if it wasn't for Roaring Kitty's tweet and the algorithmic, I suppose, response to that, then we were probably going to test the 204-hour moving average prior to earnings, way down at 25. That's probably what was going to happen. That's not what happened, right? And so maybe something like that happens again this time. Right, Max Payne is still down there at 25, and right, our gamma exposure environment looks like this, right? So, right, this is a mess. We've got, like I said, we've got this little kind of speed bump here. This call gamma accumulation at 27. It looks like a lot of calls came in at 27 yesterday to bet on the probability of a reversal off of 28. Call gamma right now is showing as pretty light at 25 based on our price position up here. We do have quite a few more calls at 25, so I think that would skew to a more supported position if we got closer. Like if we move down to 26 or 25, like the call gamma would kick up. Just too much of it has been already hedged, I think, for that to be too meaningful at this point. So it would be it would probably strengthen in terms of probability over. Traders would probably take some bets on that if we approach 25. Right, so we're back up in here. We're back up kind of in this area, but this is right. This is very. There's not a lot of dealer pressure in here, so this is going to be more than usual affected by options flow and whatever is going on right now in ETF land. So this is going to be very much affected just by the flow of our trading. Hedging, gamma hedging is not going to play. I mean, there'll be new hedging that comes into place as new contracts are opened in the options market, but in terms of static principles and static character, we don't. Between 27 and 30, we have very mild, very minimal changes. Like look at these net values. 28 is essentially perfectly neutral. But again, there may be, because of this put gex position. If it's, again, I need to figure this out. If with put walls, it's a Vanna thing that's going on there, then we might have that little bump. But we'll have to see. And two, this landscape will probably change pretty dynamically based on what's going on with the broader market. So we'll have to see. For the meantime, I mean, right, just as yesterday, this $30 position required 700,000 shares in 6 minutes to punch the price through that level. It's going to require something of an equivalent magnitude to bring us back up through there, right? It's going to require that much demand, because market maker hedging at that position is going to supply at least that much in terms of, supply. But if we get some sort of catalyst that launches us, like it did on December 5th, back up into this area, we're back in positive gamma land. And the question then is how, or if, whether that move, that type of action would then drive enough options activity to fill out our options chains going forward, so that we won't have this kind of decoupling of the price from this range. I think it's possible whoever engaged in initiating this volatility cycle now decided it was worth the risk to kick things off prior to Opex, rather than risk the price being at an elevated level at 32 or something, having Roaring Kitty drop a tweet, having Ryan Cohen say, announce some kind of project or something, having an institution kind of make some kind of other bullish move to keep the price up there, risking that from happening, and then kind of coming out of Opex being trapped at this higher volatility level, or having to try to start a new volatility cycle off of this higher level. I suppose that's my thoughts for that. Right, we, in terms of the longer vision on GameStop, right, in terms of what we're going to be thinking about, I guess, coming out of January Opex, the same terms that I've been thinking about, or thinking in, I should say, on Monday and Tuesday, as far as the sort of things I've been looking for, or sort of what I'm looking at for our options chain coming out of January Opex. None of that's changed as a result of what occurred yesterday. It's an interesting development in terms of what I suppose I would have expected going into this point. And it seems, right, from our open interest data too, that that pretty much a very substantial portion of the market anticipated. This is also what makes me think it was one institution that primarily pulled this off. It's not like we had put buildup. If it was several institutions, if there was some sort of external factor and multiple institutions caught wind of this factor, like you would see a buildup of maybe long put gamma as you saw institutions try to take advantage of that. And we did not see that. Most of what we saw take place in terms of options trades yesterday was chasing what was happening, not anticipating it. So it really looks to me like this was a very large institution if they were able to borrow 700,000 shares and dump them on the tape in a few minutes. This was a very big institution, and I'm inclined to think it was one that really pulled this off. So very interesting stuff, right? The project continues. Off we go into January Opex. Let's see what happens. So thank you very much, as always, for all of you for watching and listening. We'll look forward. Good luck with your trades today. Good luck with investing, and we'll see you guys tomorrow. Take care now.